Hello everybody. Today we are going to do one topic from financial reporting subject of ACCA. Today I am going to talk to you about IAS16, which relates to property, plant and equipment. Now, as you are aware, property, plant and equipment is a tangible non-current asset. So how do you account for it? Now, when you have studied the conceptual framework, we had already discussed there are 4 pillars of conceptual framework for each accounting standard, and each item in a SOFP or SOPL has to fulfill the 3 criteria related to recognition, initial measurement, subsequent measurement and derecognition. Now when I say initial recognition or the recognition, property, plant and equipment can be recognized in the financial statement if it satisfies 2 conditions. What are those 2 conditions? One, that future economic benefits should flow into the entity. There is a high probability that the future economic benefits will flow into the entity. That is condition 1. Condition 2 is that you should be able to measure the cost of property, plant and equipment reliably. Okay, if you are unable to put a value to the property, plant and equipment, at what amount will you recognize it? Therefore, the second condition is very important. That is, you should be able to measure the cost reliably. So if these 2 conditions are satisfied, you will recognize the item as property, plant and equipment. Now when we talk about the economic benefits flowing into the entity, it could be that you use the property, plant and equipment to manufacture certain items, you use the property, plant and equipment to provide certain services, you use it for administrative purposes. So the purposes could be multiple. Right? And also one thing is that as I said, it is a non-current asset. Therefore, the benefit should be coming in, the inflow of the benefit should be for a longer period, that is more than 1 accounting year. So again, I repeat, the recognition criteria, probable economic benefits flowing into the entity, and secondly, you should be able to measure the cost reliably. Now, when we talk about initial measurement, when you are going to record the property, plant and equipment for the first time, how are you going to put a value to it? Of course, as I said, there should be a reliable measure. So you should be able to identify the costs related to the property, plant and equipment. So when you are doing the costs, calculating the cost related to property, plant and equipment for the first time, you will include all the costs incurred in getting the asset or the property, plant and equipment to the current position for the intended use. So that would include the purchase price, that would include the duties, import duties, etc., which are not refundable or which cannot be set off. It may include the labor costs which are required to set up the property, plant and equipment. There could be any number of items related to the property, plant and equipment in getting that asset to the present condition for its intended use. All this you have already studied in FA, but there is one more cost which is a future cost of dismantling the asset. It may happen that you will use the asset for, let's say, 10 years. So after 10 years, you may have to dismantle the asset and get the and dispose of the asset. So there is probably a cost involved there. Okay, let's take an example. Suppose the purchase price of an asset. Purchase price of an asset includes let's say $10,000. Then installation cost incurred is say 500. Import duty that you have paid, which is maybe non-refundable, is 150. Then of course, if there is any test runs that are carried out, that also have to be capitalized or will become a part of the cost. So if there are any test runs that happen, maybe let's say 50, that would also be a part of it. And then finally, there will be a dismantling cost of, let's say, 100 at the end of 10 years to be incurred after 10 years. So while calculating the cost of the asset, you need to find out the present value of this 100 using the cost of capital. So in this case, let's assume cost of capital is say 10%. So using the present value formula, let's calculate the cost of capital. So you want to know, let's calculate the present value. So you want to know what is the present value of this 100 which you are going to incur after 10 years. So 100 multiplied by 1 upon 1, 10% it is, and after 10 years, right? So this is known as a discounting factor. Either you can use the calculator and find out the discounting factor, or use the discounting factor table to calculate the value. So the value of 1 upon 1.1 raised to 10 is 0.3855. So when you multiply this by 100, I will get a present value of 38.55. So when I am doing the cost of the asset, this dismantling cost will be calculated based on the present value. So instead of this 100, I am going to use the present value cost, which is going to be, let's round it up to 35. So the total cost of the property, plant and equipment, 38. So the total cost of property, plant and equipment would be 10,000 plus 500 plus 150 plus 50 and 38. So that will come to $10,738. Okay. So you will recognize this property, plant and equipment at cost at 10,738. So that is your initial measurement, right? I hope this is clear. Now there are certain costs which are never ever to be capitalized. Which are those costs? The general overheads that are incurred, the administrative overheads that are incurred, the labor training costs that are incurred. These are the costs which you will never include while calculating the cost of the asset. I hope it is clear so far. Now let's go to the third point, that is subsequent measurement. Now as I said, okay, the life of the asset is 10 years. Using straight line method, depreciation is calculated. So depreciation would be 1,074 would be the depreciation. So every year you would be charging this amount as depreciation. Now one more thing that you need to understand is, when we found out the present value of dismantling cost to be incurred after 10 years, okay, what exactly are you doing? The entry in that case is that you are creating a provision for dismantling. Okay. So when you purchase the asset and you have estimated the cost of dismantling as 100 after 10 years, and the present value we calculated was 38. So this would be your provision which you have created. So there is another entry that you need to pass related to this asset. Every year you will add 10% to this provision, so that at the end of 10 years you will get an amount of 100 which is required for dismantling. So when you are charging 10% or adding 10% to the provision, you need to charge that as a finance cost in SOPL. So the entry is that you will debit SOPL as finance cost. 10% for the first year will be 3.8. Let me round it up to 4, or Let me just take it as 3.8 itself. And you will credit it to the provision for dismantling 3.8. So every year this provision will keep on increasing. So at the end of 10 years you will have your $100 for dismantling. So if at all a question is asked, in the first year, what are the charges to be charged to, what are the expenses to be charged to SOPL related to this asset? So the first thing that you will do is you will charge depreciation, and the second thing you will charge is the finance cost that you are going to incur. So your correct answer should be 1074 plus 3.8. So that would give you a correct answer of $1,077.8. Okay. I hope you have understood this, right? Now coming to subsequent measurement. Okay. There are two methods of subsequent measurement which are allowed by IAS16 related to property, plant and equipment. What are those? First, you can continue to value it at cost less accumulated depreciation, or you can use revaluation. Okay. Now, revaluation method is used when the value of the property keeps changing over the years. So, faithful representation can be done if you are using the revaluation model. Now, let's continue with the example. One more example. Suppose the initial recognition of an asset was 1,000, right? 10 years is the depreciation, 10 years is the useful life of the asset, but you have decided to follow the revaluation model, right? So, at the end of, you will continue to depreciate it straight line method, right? Estimated useful life is, let's say, 5 years in this case. So, depreciation would be how much? Depreciation would be 200, correct? Now, at the end of year 2, right? You are depreciating 200 per annum. So, what happens at the end of year 2? The carrying amount would be 1,000 minus, now end of year 2, that means you have depreciated it for 2 years. So, 2 into 200 is the depreciation total. So, the carrying amount would be 600, correct? Now, suppose I tell you the asset is revalued at fair value, and the fair value is not 600 but it is 800, okay? So, let's say the fair value of the asset is 800. What happens then? There is a gain related to this asset of 200, right? So this is recognized as revaluation gain. The journal entry for that is, now when you are recognizing this gain of 200, you will not recognize it in SOPL, but you will recognize it in statement of other comprehensive income, that is OCI. Okay. Let's have a look at the journal entries that we are going to pass while revaluing the asset. As I said, the cost of the asset was 1,000. So when you are maintaining in your records, non-current asset at cost 1,000, accumulated depreciation was 400. So at the end of year 2, in statement of financial position, in a column it will show cost 1,000 less accumulated depreciation 400, and in the outer column 600. Right? Now, as I said, the asset is revalued to 800. So there is a gain of 200, right? So how are you going to pass this entry? So what we need to do is, first we need to cancel out this accumulated depreciation. So the journal entry would be debit accumulated depreciation 400, right? we are creating a reserve here for revaluation surplus, which is 200. Okay, so credit revaluation surplus, which was 200, correct? And we need to show the non-current asset at 800, right? So we need to reduce 200 from the asset. Therefore, we will also credit non-current asset 200. Okay. Now, at the end of year 3, assuming the life of the asset is the same, you will charge depreciation at end of year 3. End of year 3, we need to calculate the depreciation. Now, as I had told you initially, the life of the asset was 5 years. 2 years are already over, so the remaining useful life is now 3 years. So, the new depreciation would be 800 divided by 3 years. So, that would give you an amount of $267. Okay. Now, what was our initial depreciation? It was 200 per annum. What is the new depreciation? 267. Now, if you look at the revaluation surplus of 200, which is a gain for us, right? But as long as we are using the asset, the actual gain cannot be realized. But what we can do is, we can transfer this revaluation surplus part by part over the remaining useful life of the asset to retained earnings. So how much amount can we transfer to retained earnings? So it is calculated as difference between the old depreciation and the new depreciation. So, and this will not reflect anywhere in SOPL. It will come in statement of changes in equity. So, you have a revaluation surplus of 200. You also have retained earnings, whatever is the balance. And here you will show transfer. So, you will subtract 67 from revaluation surplus and you will add 67 to retained earnings, and whatever is the balance that is here will be transferred to SOFP under equity. So, this way, this revaluation surplus is getting realized over the remaining useful life of the asset. So, some companies may use this provision, some companies may not use this provision. Now, suppose you sell off this asset at the end of 4 years, right? So, at the end of 4 years, if you have a revaluation surplus balance related to this asset and you sell off this asset, then the balance in the revaluation surplus will then be transferred to retained earnings, because after you sell off the asset, the gain will be fully realized. Okay, this is what revaluation surplus was about.